Mamta, Niranjan, good morning. So in the last class, we had started off discussions on Ind AS 113, that is fair value measurement. Very critical standard from Ind AS perspective. There was no corresponding standard in your IGAP regime. So we saw what exactly it means, what is the reason why this standard is important, because be it financial instruments, non-current assets held for sale, or agricultural, or your agriculture standard, in all these places, you are having references to fair value. And beyond this also, you will be having. So that is why it was critical to establish a framework for fair value measurement. And that is what has been achieved by the standard. The standard does not give a fair value formula. Rather, it gives the principles for determining the fair value. So when we talk about the principles, it started off with a definition on the fair value, which mentions that it is a market participant based value in an orderly transaction between the market participants at the measurement date. So this is the first key takeaway. The second key takeaway is that this is nothing but an exit price. The price that you would get if you were to sell an asset, or that you would pay to transfer a liability, not settle a liability. So that is what is your fair value. It talks from the perspective of an exit price. When we look at the market-based values, it talks about the transaction happening in an appropriate market. So we saw two categories of markets. One is your principal market, where you have maximum number of buyers, maximum number of sellers, maximum number of transactions, such that no individual buyer, seller, or transaction is capable of influencing the market as a whole. So this is more like a perfect competition situation. Everybody is aware of the transaction, and therefore the price will always tend towards its fair value. You cannot find any major deviations therefrom. If the principal market is not available, then we come to the most advantageous market. The most advantageous market is that market which maximizes the net proceeds for the entity. Now, what is your net proceeds? Net proceeds is nothing but your expected selling price minus the transportation cost minus the transaction costs. So that will give you your net proceeds. The market where your net proceeds are highest becomes your most advantageous market. And for that market, we have to determine the fair value, which is nothing but expected selling price minus the transportation cost. We do not deduct the transaction cost because it is a characteristic of the transaction and not of the commodity. So that is what was your fair value determination. And that was where I think we had ended. Okay. We also saw valuation of non-financial assets, where the non-financial assets can have multiple uses. So there are three parameters which we will have to test. Is it physically possible, legally permissible, and financially feasible? These are the three parameters on which your non-financial assets valuations is based. What is important to note is that in absence of potential best use not easily available, the current use itself would be considered as the best use. And for considering fair value under any alternative use, you will have to deduct the amount incurred to make the asset ready for that specific usage. So that is your valuation of non-financial assets. So any doubts till now, anyone? Any doubts? I think no doubts. So then we moved on to valuation techniques. So valuation techniques, when quoted prices are not available, we use these techniques to estimate the price. Now, when we talk about valuation techniques, there are two inputs. One is your observable inputs and the other is your unobservable inputs. The rule that we have to remember is we need to maximize the usage of observable inputs and minimize the usage of unobservable inputs. Minimize the usage of unobservable inputs. What do you mean by observable inputs? Directly available, like the stock price on the National Stock Exchange or gold prices that are there for the particular day. So these are all directly observable inputs. You don't do any adjustment to them. And when you talk about unobservable inputs, these are basically your estimates, assumptions, where there is a risk of an inbuilt bias. So these are based on entities' own assumptions. Like for example, you have the DCF method of valuation. Like you have the DCF method. All the future cash flows is nothing but your estimates. Okay, so that is how you are going to look at it. So inputs to valuation techniques is done. We categorize them into three levels, level 1, 2, and 3. Level 1, these are unadjusted quoted prices. You take the value and put it as your fair value. There is nothing that you need to do. This is the most reliable and the easiest method of calculating the fair value. When we talk about level 2 inputs, these could be the quoted prices subject to certain adjustments. We saw the case of a company like Volkswagen, which does not have listed shares. But if I were to value it, then I could probably take a comparable like Suzuki or Hyundai, for example, and then make some adjustments on account of liquidity discount or market share adjustments, whatever be the case, to arrive at the fair value for the shares of Volkswagen. Coming to level 3 inputs, these are entirely unobservable. Okay, these are entirely unobservable. And therefore, there are a lot of assumptions, a lot of estimates which are involved. And basis that you determine the fair value. Okay, so that is done. Now, I hope you saw these 2, 3 questions, whatever are there. Okay. I hope you saw these 2, 3 questions. Key question is, if a market participant takes into account the effect of restriction on sale of an asset, an entity would adjust the quoted price to reflect the effect of that restriction, obviously. If that quoted price is a level 2 input, the adjustment is an unobservable input that is significant to the entire measurement, then we would categorize it within level 3 of the fair value hierarchy. Okay. So what is it trying to say is you are having a level 2 input and then you make an adjustment. Now this adjustment is significant. So therefore, you are going to arrive at you will be treating it as a level 3 fair value hierarchy. Okay. So we have a question that has come up. Is there any best use for intangible assets? Definitely. Either you can keep your intangible assets with yourself and give it out on a royalty basis, or you can consider selling the patent to somebody. Yes. So when you sell the patent, you are basically giving away the rights for the sole exclusivity rights that you enjoyed. So there are multiple uses for intangible assets also. Now, what is the best usage for intangible assets is something that you will have to determine based on the intangible asset that you own. For example, if you look at your movies, okay, your movies which are there, you are giving distribution rights in theaters. That is one way of recovery. You are giving streaming rights on these platforms like Netflix, Prime Video, etc. That is another. You are renting it out. Okay, you like these entities have come out with rent a movie models. Okay, so that is also there. And finally, you will create copies of the movie on digital media like CDs, DVDs, etc., which used to come long time back, and then you can sell them off. So your intangible asset is the movie itself. Yes, the movie itself is generating your revenue, and these are the various ways in which you can generate it. So any of these could be your highest and best use. Okay. Now, coming to the next one, I hope you tried these inputs, these questions, level 1, level 2 inputs, certain examples are there. Okay. Now, let us understand this. Okay, so this was a review of what we had done so far. Now, the next set of questions, today we'll be having some question solving, and largely the theory of what we have studied so far will be applied today. Only new part what will be left is uh, application of fair value concepts to liabilities and equity. Okay, that is the only new thing which we will be discussing today. Okay, now adjustment to a quoted price when it does not reflect the fair price. Okay, so sometimes what could happen is on 31st March, I'm having shares. Okay, my shares are listed on the stock exchange. Now, 31st March, the markets typically close at what time? The markets close at 3:30 p.m. So 3:30 p.m., I will have the last quoted price of my equity share. Now, between 3:30 p.m. to 12 midnight, there is a significant event that has happened. There is a significant event that has happened. This I'm talking on 31st March. Between 3:30 and night 12, there is a significant event that has happened. Now tell me, when will the impact of this significant event come on the stock exchange? When will it come on the stock exchange? Significant event could be resignation of a key managerial personnel. Significant event could be uh, you got an approval for one of the licenses that you had applied for, and now that exclusivity lies with you. Significant event could be a fire that has happened at 6 p.m. that evening, and it has gutted out your entire manufacturing facility, your entire inventory, everything is gone. Yes. So these are significant events which have happened after 3:30 p.m. Unfortunately, the impact of this is visible only on 1st April at 10 a.m. in the morning. Unfortunately, the impact of this is visible only at 10 a.m. in the morning. Are you able to follow? Are you able to follow? Yes. Now, my question to you is, suppose an entity is holding shares in this company. Let us suppose this company is A Limited. Suppose I am in the books of B Limited. B Limited is holding shares in A Limited. Now, shares have to always be fair valued. There is no option. My question to you is, will the value at 3:30 p.m., which is a quoted price, a directly quoted price, will this 3:30 p.m. value be a fair value, or will the 10 a.m. valuation on 1st April become your fair value? Let us suppose this price is 1,000, and by virtue of the event, the price has risen to 1,200. So now my question to you is, what are you going to pick up as your fair value? Will you pick up 1,000 rupees? That is the closing valuation on 31st March. Or will you say that, no, there has been a significant event which has happened on 31st March, and therefore 1,000 rupees is not an accurate representation of the fair value. 1,200 is an accurate representation. What are your thoughts on this? Which value would you take? 31st March or 1st April? I'm closing the books on 31st March. Okay? So tell me, come on. Hello? Not able to hear you.
1000, sir.
Yeah, please tell me again. As on 1st April. As on 1st April. That's right. You will be taking the value as on 1st April 10 a.m. valuation. But sir, 31st March ka quoted value, if somebody looks at it, if somebody looks at the quoted price on 31st March, he will see 1,000 rupees. Then he will look at your balance sheet and he will see 1,200. So therefore, is this a direct quoted price of 31st March? No, it is not a quoted price of 31st of March. So are you doing an adjustment to the value of 31st of March?
Yes, sir.
Yes, you are doing an adjustment. Adjustment means you are taking the valuation on 1st April. So basically 200 ka adjustment up kar raha. So will it be a level 1 measurement now? Answer is no. It would no longer be considered a level 1 measurement. Is it okay? So what is important is the company's valuation policies and procedures should address how these after our events will be identified and assessed. Controls to be put in place to ensure that any adjustment made to quoted prices are appropriate and applied in a consistent manner. Okay, so that is your valuation techniques adjustment to quoted price. Okay, now let us proceed with this example. Okay, A Limited, a large biotech company which shares traded publicly, has developed a new drug that is in the final phase of clinical trials. B Limited has an equity investment in A Limited's shares. B Limited determines that the shares have a readily determinable fair value and accounts for investment at FVTPL. B Limited assesses the fair value as of the measurement date of 31st March 2020. Consider the following. On 31st March 2020, the Drug Approval Authority notifies A Limited's management that the drug was not approved. A Limited shares closed at 36 on 31st March 2020, issued a press release after the markets closed announcing the failed clinical trials. A Limited shares opened the next day at 2250. So 36 se aake it fell down to 2250. Now, this drug failure is a condition of the asset being measured that existed as of the measurement date. Okay, now B Limited concludes that 36 rupees closing price does not represent fair value of A Limited shares because the price does not reflect effect of the authority's non-approval. The subsequent transactions that take place are relevant to the fair value measurement recorded as of the measurement date. Opening price of 2250 indicates how the markets would have incorporated the effect of non-approval. B Limited adjusts the 31st March 2020 quoted price for the new information, records the shares at 2250 and discloses the investment as a level 2 measurement. Are we able to understand? Yes, Jeannie, did you follow? Pooja?
Yes, sir.
All right, perfect. Okay, so that is done. So adjustments. Okay. Now, what are my approaches to valuation? यहाँ पे हम थोड़ा सा deviate कर रहे हैं. This is strictly not accounting or reporting. यहाँ पे हम थोड़ा सा deviate करके we are moving into a little bit of financial management. Okay, where you will be. There have been certain questions which have come based on calculations of fair value. Okay. Since it is there, we will be covering that. Okay. Now, approaches to valuation. Market approach. You are using the prices and other information generated by market transactions involving identical or comparable assets, liabilities, or a group of assets and liabilities, such as a business. And then you will be using market multiples derived from a set of comparable companies. Example, enterprise value by EBITDA or the PE multiple. Okay, so we'll see this. So this could be one approach, market approach. You basically take the market values and then you do some adjustments to arrive at your fair value. The second one could be income approach. So this is nothing but example could be your DCF method like Gordon's formula. Okay. So the income approach converts future amounts to a single current discounted amount. Okay. Assumption of future cash flows and appropriate discount assumption of future cash flows would be based on market participants' views. So is there a likelihood of bias which is involved here? Is there a likelihood of bias which is to be involved here? Obviously, yes. Obviously, yes. Related risks and uncertainty to be considered would be taken in cash flow or the discount rate. तो जो भी uncertainty है, या तो आप cash flow बदलो या फिर you change the discount rate. Okay. Cost or asset approach, basically your net asset value method. Okay. Describes how much cost is required to replace existing asset or liability to make it in a working condition. All related cost will be its fair value. It actually considers replacement cost of the asset or liability for which we need to find fair value. Are we able to understand? Yes.
Yes, sir.
Any doubts? Anyone? Not necessarily value of shares. These are anything. Okay. But Basically, these are the approaches. Okay, these are the approaches. Okay, it's not restricted to shares. It's definitely not restricted to shares. Valuation approach to be consistently followed. If there is a change in valuation approach, treat it as a change in accounting estimate as per Ind AS 8. That is, you will disclose the reasons for such change. Okay. Now, let us start off with one of these illustrations. Okay. Investment 1 is a contractual right to receive 800 rupees in 1 year. There is an established market for comparable assets, and information about those assets, including price information, is available. Of those comparable assets, investment 2 is a contractual right to receive 1200 in 1 year and has a current market price of 1083. Investment 3 is a contractual right to receive 700 in 2 years with a market price of 566. All three assets are comparable with respect to risk, that is dispersion of possible payoff and client. Measure the fair value of asset 1 based on the above information. Okay, fine. Now, tell me one thing. Investment 1, contractual right to receive 800 in how many years? 1 year. So, I am doing a fair valuation of investment 1. Do you agree? I have to do a fair valuation of investment 1. And comparable, I am having investment 2 and investment 3. Yes or no?
Yes, sir.
Okay. Now, the question is, investment 2 is a right to receive in 1 year. Investment 3, a right to receive in 2 years. So when I have to take the decision of which is comparable, आप कौन सा लोगे? Is
Investment
investment 2 comparable to investment 1 or investment 3 comparable to investment 1?
investment 2, sir.
Investment 2. Everybody is okay? Nisha, you're okay with that? Pooja, Mamta? Yes? You are supposed to receive this amount in 1 year. So that is why investment 1 and investment 2 are comparable. Now, investment 2 fair value. Investment 2 fair value. कितना है? 1083. Yes or no? Anybody has any doubts here? No. So if I look at investment 2, what it is looking like is this. Today the value is 1083 market value. After 1 year, it is coming to 1200. Are you able to understand this?
Yes, sir.
Yes. So basically, if I put 1083 today, I will get 1200 later on. Are you able to follow? That means 1083 opening plus interest R is equal to 1200. Are you able to follow?
Yes, sir.
Yes. ये तो simple arithmetic है. So I'm just following it up here. 1 plus R is equal to 1.108. You can check 1200 by 1083. 1.108. Therefore, R is equal to 0.108, or that is equal to 10.8%. Anybody has any doubts still here?
No, sir.
Understood? Yes. So can I say that I am supposed to receive 800 in 1 year? So can I say that principal 1 plus R is equal to 800. Therefore, P is equal to 800 divided by 1 plus R. So 1 plus R means 1 plus 10.8%. 10.8%. So 1.108. So that comes to 722. Are we able to understand?
Yes, sir.
Yes. Pooja, Nisha, Niranjan, Mamta, Usha.
Yes, sir.
Yes, sir.
Okay. All right. Perfect. So this will be your fair value. अच्छा कौन सा मेथड होगा लेवल 1 लेवल 2 और लेवल 3 इनपुट्स
Level 1, sir.
लेवल 1 2 और 3
Level 1, sir.
no mama it won't be level 1 because you are taking investment 2's value
Level 2, sir.
arriving at the rate and then applying this rate here. So am I making an adjustment to the valuation? Answer is, am I making an adjustment to investment 1 using another observable input? Answer is yes. So it will be level 2 valuation. It will be level 2. Level 1 क्या होता है पता है? If I were to value investment 2 and investment 2 ये data दिया है and I will say fair value is 1083. That is level 1 valuation. Level 1 input. That is level 1 input. यहाँ पे I am adjusting the current period. I am adjusting investment 1 based on input of investment 2. So this is a level 2 input. Did you follow? Yes. Nisha, did you follow? Pooja.
Yes, sir.
Okay. So that takes care of this. So your level 1 input is just copy and paste without using any of your efforts. Okay. Just take the value, plug it here. Take the value, plug it here. What they call plug and play. Okay. You don't have to do anything. Okay. Now, let us see one more example. An entity has estimated its next year earnings, that is cash flow, based on certain probability as mentioned below. Okay, so possible cash flow, probability weighted cash flows. So total expected cash flow is 820. Risk-free rate is 6%. Therefore, present value of cash flow for 1 year is 820 divided by 1.06. So that comes to 773.58. Of course, यहाँ पे बहुत कुछ डेटा दिया नहीं है. Like how did they get this 820? That is this. Okay. But apart from this, no other data is given. Okay. But my question to you is, what do you think is the inputs, level of inputs? Is it level 1 input, level 2 input, or level 3 input? Yes,
Level
Nisha?
3, sir. Level 3, sir.
Level 3.
Level 3, yeah.
Okay. Ginny,
Yes, sir. Level 3.
Hemant, level 3. That's right. So this is your level 3 inputs. Level 3 inputs. Okay. In the previous question, Hemant is asking, what do we do with investment 3? Investment 3 is meant to confuse you. If you take investment 3, you are confused. Okay. You have made the examiner's job easier. If you have taken only investment 2, then it's okay. All right. So this is done. Example 16. Now, let us move on to certain valuation based questions. Okay. I have shared some questions. Okay. And I have tried to put in some information about valuation methods. Okay. So, this is not there in your study mat explicitly, but यहाँ illustration के तौर पे it is there. So what we have done is we have just put that data in one place for you to understand. Okay. So now when we talk about your valuation methods, we derive something known as enterprise value. We derive something known as enterprise value. Enterprise value is nothing but value of debt plus value of equity. Are you able to follow? Yes, value of debt plus value of equity. Now, in absence of any information, the value of a company given in the question can be considered as enterprise value. Okay, the information given in the value of company given can be determined as the enterprise value, which is nothing but debt plus equity. To find out the value of equity, क्या करोगे आप? You just remove debt from the enterprise value. Okay. To find value of equity, deduct the value of debt from the value of the firm or the enterprise. Value of debt. Debt क्या है? Debt is usually interpreted as net debt. Net debt being total debt minus cash and cash equivalents, because obviously those cash and cash equivalents can be used to fund the debt immediately. This is based on the presumption that cash and cash equivalents would be used to settle the debt immediately. Are we able to understand? Yes?
Yes, sir.
Okay. So this is your basic information that is given. And now, please go through this question. Okay. Please go through this question. Give me a minute. All right. Yeah. ABC Limited acquired 5% equity shares of XYZ for 10 crore in the year X1, X2. The company is in process of preparing the financial statements for the year X2, X3 and is assessing the fair value at subsequent measurement of the investment made in XYZ Limited. Based on observable inputs, ABC Limited identified a similar nature of transaction in which PQR acquired 20% equity shares for rupees 60 crores. The price of such transaction was determined on the basis of comparable companies method, enterprise value by EBITDA, that is 8. This is a multiple. We call this as a multiple. EV by EBITDA is a multiple. Like how price earnings, PE ratio is also a multiple. For the current year, EBITDA of XYZ is 40 crores. At the time of acquisition, the valuation was determined after considering 5% of liquidity discount and 5% of non-controlling stake discount. What will be the fair value of ABC Limited's investment in XYZ as on the balance sheet date? As on the balance sheet date. Are you able to understand the question at least? Yes? At least, am I able to understand the question or not? See. Okay. So now, ABC Limited is having 5% shares in XYZ Limited. Are you okay with this? This is the first part.
Yes, sir.
This is the first part. Now, based on observable inputs, ABC Limited identified a similar transaction in which PQR acquired 20% equity shares. PQR Limited acquired 20% shares in XYZ Limited for how much? For rupees 60 crores. For rupees 60 crores. Are you able to understand? Yes. Now, the price of such a transaction was determined on the basis of comparable companies method, enterprise value by EBITDA, which was 8. Okay. So now let us come back to this. EV by EBITDA value is 8. Now, what is your EBITDA? What is your EBITDA? EBITDA of XYZ is 40 crore. Whose EBITDA we want? We want XYZ Limited's EBITDA only because I am valuing the investment in XYZ Limited. Therefore, EV is equal to 8 multiplied by 40. 320. Are you able to understand? This is your enterprise value. Is there any doubt till here?
No, sir.
Jimmy, Pooja? Yes, all clear? Okay, so no doubts. So now, at the time of acquisition, the valuation was determined after considering 5% of liquidity discount. Okay. So my starting point is 320 crores for entire shares of XYZ. But my stake is how much? My stake is only 5%. So
Sir.
320 into 5%, 60. Are you able to follow?
Yes, sir.
Now, the valuation was determined after considering 5% liquidity discount. So therefore, 5%. And I also have an NCI discount. I also have an NCI discount. Why? Because the comparable transaction is for 20% equity shares. Yes or no? Yes. See, my comparable transaction is for 20% stake. Yes or no?
Yes, sir.
Now, 20% stake in most of the cases will give you a seat on the board of directors. Okay, it will most often end up giving you a seat on the board of directors. But a 5% investment, a 500, what you can say, a 5% investment, will it give you any rights?
No, sir.
Answer is no. So therefore, my shares, to the extent of that rights, should be lower. Yes or no? अरे भाई, कंपेरेबल ट्रांजैक्शन है 20% स्टेक परचेस जिसके हिसाब से हमने किया. Now in the current scenario where we are at 5% stake, should I, where we are at a 5% stake, am I in a better position compared to the 20% stake transaction?
No.
No. तो इसके वजह से there is a discount that is attached to it. That discount is known as non-controlling interest discount. Are you able to follow?
Yes, sir.
Yes. So therefore, fair value of investment in XYZ Limited comes to 14.4. Anybody has any doubts here? Please ask. Please ask. Liquidity discount? Well, ABC Limited's stake, it is applied if the stake held is illiquid. Okay. Now, so probably what they want to say is your shares are not liquid in the market, and that is why they have given a 5% liquidity discount. They have given a 5% liquidity discount. Okay, all right. So 5%, less 5% non-controlling interest discount. So 0.8. So that gives you 14.4. Anybody has any doubts here? Okay, whatever I told you, seat on the board of directors, etc., is explained here. This is only for information. This is only for information. Okay, all right. Next. Shall we proceed further?
Yes, sir.
Okay. Now, another question. Another question. Okay. UK Limited is in the process of acquisition of shares of PT Limited as a part of a business reorganization plan. The projected free cash flow of PT Limited for the next 5 years are as follows. Okay, so you are having the cash flows. Now, the weighted average cost of capital is 11%. The total debt as on measurement date is 1,465 crores. Surplus cash and cash equivalent is 106.14 crores. Total number of shares of PT Limited is 8.53 crores. Determine the value per share of PT Limited as per income approach. As per income approach. Did you understand the question? Yes.
Yes, sir.
Anybody has any doubts in the question? Go through this question once again. Go through the question once again. A minute. Yeah. Could you go through? Yes. All right. Now, certain points of discussion. Okay. See, first of all, which method of valuation are we using? Am I using market approach, income approach, or cost approach?
Income approach.
Income approach. Okay. Now, when we talk about income approach, this is based on DCF method because I am given the future cash flows. Okay. Year 1, 2, 3, 4, and 5. Now, in year 5, they have given two values. One is the cash flow and one is your terminal value. Can somebody tell me what is the meaning of terminal value? Terminal value is nothing but estimate of cash flows to perpetuity. Estimate of cash flows to perpetuity. So what we have done is we have tried to kind of give you an explanation of whatever information is given. So value of enterprise is nothing but present value of all future cash flows. The cash flows are nothing but estimates of cash flows in years 1 to 5. And the terminal value is estimated cash flows to perpetuity. So what is the assumption that happens is the growth is expected to stabilize year 5 onwards, and therefore your valuation at the 5th year is going to be the D6 divided by KE minus G, where price at the end of year 5 is P5. D6 is nothing but earnings in year 6. KE is cost of equity, and G is the uniform growth rate in earnings from year 6 to perpetuity. Did you understand the data? Did you understand the data?
Yes, sir.
Yes. All right. So now we have to do the fair valuation. We are given weighted average cost of capital, WACC. ये पढ़ा होगा आपने, WACC. This is 11%. So we will take 11% and do the discounting. So I'm given the discounting factors. I'm having the cash flows at the end of each year and the terminal value of 3,965 crores. So when you discount it to the present value, you will get enterprise value of 3,105.77 crores. Is this okay till here? Yes, yahan tak theek hai?
Yes, sir.
Yes, all right. Now, this is your total enterprise value. And what did I say? Enterprise value is equal to value of debt plus value of equity. Plus value of equity. Yes or no? So, am I having debt? Answer is yes. You do have debt, 1,465 crores. But should I take debt or should I take net debt? Should I take debt or net debt?
Net debt.
Net debt. So net debt will be 1,565 minus
106.14.
106.14. So that comes to how much? Minus 106.14, 1,358.86. Okay. So if you look at your answer, 1,358.86. So that leaves you with valuation of equity 1,746.91 divided by 8.53 crore shares to give you a fair value per equity share of 204.83. All clear? Bolo?
Yes, sir.
Yes, Pooja is confirmed. Hemant, Mamta, Nisha.
Yes, sir.
Okay. Now, okay. If you look at your study material, answer is the same, but I don't want you to get panic. So therefore, if you look at this solution, they have done less debt 1,465, add cash and cash equivalents 106.14. So हमने क्या कर दिया? We have taken the
Net.
net debt and reduced that. It's basically the same. It's basically the same. ठीक है? Yes or no?
Yes, sir.
So you get the same values. Okay, you get the same values. So that takes care of question number 4. And now we move on to question number 5. Okay. Now, you are a senior consultant of your firm and are in process of determining the valuation of KK Limited. You have determined the valuation of the company by 2 approaches, that is market approach and income approach, and selected the highest as the final value. However, based upon the discussion with your partner, you have been requested to assign equal weights to both the approaches and determine a fair value of shares of KK Limited. Details of KK Limited. Valuation as per market approach, income approach, debt obligation on measurement date, surplus cash and cash equivalents, fair value of surplus assets and liabilities, and number of shares. Determine the equity value of KK Limited as on the measurement date on the basis of above details. Is it okay? Go through the question once again. Go through the question again. Done? Gone through?
Yes, sir.
Okay. So now let us look at the solution. Okay. Now, the given values, it is assumed that they are enterprise values. That means what? It means we are assuming that these two are enterprise values. Are we okay with this assumption? Yes? Acha. Then what they have said? You have been requested to assign equal weights to both the approaches. That means दोनों approach आपको consider करना पड़ेगा 50-50% weightage के साथ 50-50% weightage पे. Okay. So since equal weights are to be assigned to both the values, we will assign 50% to market approach value and 50% to income approach valuation. Did you understand? Yes.
Yes, sir.
So you can take any other weights as ultimately weighted average value will remain the same. Okay. So therefore, fair enterprise value will be 5,268 into 50%. What is 5,268? This value into 50%. Okay. And then 3,235.2 into 50%. Okay. So that comes to 4,251.7. Are we okay with this till now?
Yes, sir.
Yes. All right. Now from here, I will deduct net debt because what I have mentioned, we have mentioned that we are the same as the this valuation. Now net debt, we will have to reduce same assumption like last time. 1465.9 minus 106.14, 1359.86. So that comes to 2,891.94 crores. Are we okay till now? Yes. Are we fine till this number? Jeannie, Nisha, Pooja?
Yes, sir.
Yes. All right. Now, let us move on to the next. Let us move on to the next. Okay. Do I have any surplus assets or liabilities? Answer is yes. Do I have any surplus assets or liabilities? Answer is yes. Now, what do we do with that? So what are surplus assets and liabilities from a valuation perspective? These are considered to be non-income generating assets. Non-income generating assets. Example, vacant land held by the entity for capital appreciation as an investment property without generating any rental income. Hence, their impact should not be considered in the income approach as well. Should not be considered in the income approach as well. As such, surplus assets and or liabilities do not generate any cash. Did you understand the meaning of surplus assets and liabilities? Yes?
Yes, sir.
Yes. Now, coming to the next part, also their impact would not be considered in the market approach. Market approach takes your market valuation. Okay, takes your market valuation and applies certain multiples like your PE multiple, EV EBITDA multiple, EPS EBITDA multiple, etc. So kahin par bhi your surplus assets and surplus liabilities will not be considered because these are non-cash generating assets. So when I am arriving at this valuation of 2,892 crores, tell me one thing, will these surplus assets and liabilities be included in that? यहाँ पे ऐड हो रहा है, तो you will know that it is not included, but logically you tell me, suppose ये चीज आपको दिया ही नहीं था, can you assume that it is forming part of surplus assets and liabilities? Answer is no. Sir, Q, because number one, based on your income approach, these are not generating any incomes, and therefore they will not form a part of your income based valuation. That is as per income approach. 3235 में तो वो है ही नहीं. Now coming to your market approach, their impact is not considered in the market approach. Reason being, आप क्या लेते हो? Price earnings multiple. Price is based on price earnings multiple. You will multiply it with the EPS. EPS is based on what comes in the P&L. Yes or no? And when I take what comes in the P&L, the P&L will have only the earnings, correct? And when I multiply it with the PE multiple of a comparative entity, the comparative entity's PE multiple will not have this particular impact, It is just price divided by earnings. Did you understand? Yes? Everyone, are you able to follow?
Yes, sir.
Yes, sir.
Yes. तो ये है ही नहीं हमारे इसमें मार्केट बेस्ड अप्रोच में. So in both the approaches, these fair values of surplus assets and liabilities are not there. But tell me now honestly, should it be there to form a part of my valuation? Yes?
Getting any benefit out of this?
कायदे से should it be there for your valuation? Obviously yes. Bhai, when you are transferring a share, you are not transferring only income generating assets or liabilities. You are gaining a control over the entire assets and liabilities, including those which do not generate any income. Yes or no?
Yes, sir.
And therefore, I will be adding it separately, 312.4 crores. Any doubts here?
Clear,
No,
sir.
sir.
तो ऐड करने के बाद value of equity comes to 3204 crores divided by number of equity shares 8.53. So that gives you 375.72. That gives you 375.72 per equity share. Okay. All right. So that is done. Acha. Now my question is, are you expected to know this in a financial reporting paper? Technically, whatever we have done, these 2-3 questions today, isme, where is accounting? There is no accounting. This is report. This is more of financial management. We have put these particular questions in your reporting paper so that you are in a position to understand how the fair valuations actually work depending on those 3 approaches. That is your market-based approach, your income-based approach, okay? Market, income, and cost-based approach. Okay, so that is the reason these questions are inserted. So now you will be in a better position to understand how the fair valuation should actually be determined. Okay, so there is no question of taking any entries, but what is important is the basis for the fair valuation. Okay, so that is why these questions are forming part of your Ind AS 113. Is it okay?
Yes, sir.
Yes. Anybody has any doubts?
No, sir.
All right, fine. Okay, next. Let's move on to the next one. Okay. No. An entity owns 250 ordinary shares in company XYZ, an unquoted company. Company XYZ has a total share capital of 5,000 shares with a nominal value of rupees 10. Nominal value means face value. Face, not fair. Okay. FV mat likho. face value. Entity XYZ's after-tax maintainable profits are estimated at 70,000 per year. So it is expected to have rupees 70,000 profit. An appropriate PE ratio from published industry data is 15 before the lack of marketability adjustment. Okay. Entity A's management estimates that the discount for the lack of marketability of XYZ shares and restrictions on their transfer is 80%. A values its holding in company XYZ's shares based on earnings. Determine the fair value of A's investment in XYZ's shares. Okay. So now, after tax maintainable profit is 70,000. Do you agree? Yes. Do you agree? मेरा प्रॉफिट कुल मिला के 70,000 होगा per year. Now, what is the PE multiple? 15. What is the
15.
PE multiple? 15.
15.
But this is before any adjustment. Now, adjustment, you have taken it at 20%. So therefore, your multiple has to be multiplied by 80%. Your multiple has to be multiplied by 80%. 20% being the discount. 20% being the discount. So this comes to 70,000 into 15 into 0.8. So that comes to
8 lakhs.
Yeah, go ahead. 8,40,000 divided by how many shares are there? This is for the entire enterprise XYZ. So divided by 5,000. So that leaves you with 168 rupees per share. So 168, I am owning 250 ordinary shares. So 168 into 250 gives you 42,000 rupees. Are we able to understand this?
Yes, sir.
Sir.
Yes.
Yes, sir.
All right. Usha, Niranjan, Mamta, Hemant, all clear? Yes? Okay, fine. Now we move on to the next one. Based on the facts given in the above part, assume that A estimates the fair value of the shares it owns using a net asset valuation technique. The fair value of company XYZ's net assets, including those recognized in the balance sheet and those that are not recognized, is rupees 8,50,000. So 8,50,000 is the valuation for 5,000 shares. So 8,50,000 by 5,000.
170.
170. And this multiplied by 250 shares. Rupees
42,500.
42,500. Absolutely right. Okay. Fair value of A's investment 42,500. Any doubt so far? No doubt. So that closes question number 8 as well. So very, very important questions from the perspective of understanding the valuation techniques, approaches to valuation. Okay. All right. Shall we proceed further?
Yes, sir.
Okay. So with this, we come to an end for fair value measurement of assets. For fair value measurement of assets. We started off with assets because that is the easiest thing for us to understand. Because you have something which is an asset for you, and that is going to give you the cash. So your level of connecting to the dots is very fast when it comes to assets. Because आप कुछ बेच रहे हो, you are going to sell something. The problem is when we talk about liabilities and own equity. So when we talk about liabilities, applying fair value rules to liabilities and own equity, what is there? I am having either a financial liability like borrowings or trade payables for which I have an obligation to deliver the cash, or I am having a non-financial liability, that is advance received towards sale of property, plant and equipment. Or third case, you are having entities own equity instruments. Example, equity issued as a consideration in business combinations. So you will study in business combination that one of the ways in which purchase consideration can be discharged is by issuance of own own equity. Own equity should always be at fair value because your purchase consideration should be at fair value. You remember I told you for goodwill to be at fair value, you need three things at fair value. Assets taken over at fair value, liabilities taken over at fair value, purchase consideration at fair value. When you compare all these three things, the last item is going to be your goodwill as a balancing figure. It will automatically come in at fair value. Is it okay? Yes. Recollect this. So when I talk about liability or own equity, it could be either of these things. Okay, this is not a restricted or a limited perspective. It will be having a broader implication. But basically, what is our assumption is that this is transferred to a market participant. It is not settled. It is not settled. So basically, the liabilities or equity instruments so transferred remain outstanding on the date of measurement. They may not be there in my books, but they will definitely be a live, what you can say, they will definitely be a live uh, value in respect of these liabilities and or equity values. Is it okay? Yes?
Yes, sir.
Value rahega inka. Okay. So now, how do I measure? How do I do the fair valuation for liabilities and equity? So first thing is use all observable inputs. Use all observable inputs and should minimize any unobservable inputs. So ये rule तो चला आ रहा है. That is maximize the usage of observable inputs, minimize the usage of unobservable inputs. The transaction considered to find fair value should be evaluated within an or with an orderly transactions. With an orderly transaction. Ind AS 113 specifically provides guidance on the retrospective scenarios while evaluating fair values of the liabilities and own equity instruments in case direct quoted prices are not available. Okay. All right. So now let us look at that. Did you understand the whole point? The point that we take from this is when I'm measuring the fair value of liabilities and own equity, it will be based on the assumption that these are only transferred, but they remain existing, they remain open as on the date of measurement. Is it okay? Yes? Is it okay?
Yes, sir.
All right, fine. So that closes your this slide. Now we look at certain examples. Okay, this is one example. This is important from the perspective of understanding financial liability, a liability fair valuation. Bank holds a debt obligation with face value 1 lakh, market value 95,000. Assume that market rates are consistent with the amount in the note. However, there is a 5,000 rupee discount due to market concerns about the risk of non-performance by counterparty 1. Okay. So I have a face value 1 lakh, a market value of 95,000. Now, counterparty would be required to pay the face value of the note to settle the obligation because the bank might not be willing to discount the note by the market discount or the credit risk adjustment. Therefore, the settlement value would equal the face value of the note. Are you okay with this? Yes,
Yes, sir. Yes, sir.
Yes, sir.
Jeannie, all clear. Okay. Now, pay the face value, that is 1 lakh, to settle the obligation, because bank is not willing to discount the note by the market discount. Therefore, settlement value would equal the face value 1 lakh. Now, to calculate the transfer value, counterparty 1 must construct a hypothetical transaction in which another counterparty with a similar credit profile is seeking financing on terms substantially the same as the note. Counterparty 2 could choose to enter into a new note agreement with the bank or receive the existing note from counterparty 1 in a share transfer transaction. In this hypothetical transaction, counterparty 2 should be equally treated to obtain financing through a new bank note or assumption of the existing note in return for a payment of rupees 95,000. Therefore, transfer value would be 95,000, and thus that would be the fair value. Are we able to understand? Yes. So there is another entity that needs the money. Okay, so let us suppose I am A Limited. Okay, we will use their terms only. I am counterparty 1. Counterparty 1, and there is counterparty 2. I am having a debt obligation with face value 1 lakh. Yes, I am having an obligation with a face value of rupees 1 lakh. This is nothing but debt. Now, CP2, counterparty 2, also needs money, but he is not in a position to go to the bank, wait, submit all documentation, etc., etc. So what he will do is, what counterparty 2 will do is, number 1, it will come to counterparty 1 and say, look, you are having debentures. I will accept the liability of those debentures. I will accept the liability of those debentures. So CP1 will tell you, I will transfer it, but how will we negotiate the transfer? So what they decide is, well, today the fair value of this instrument, is how much? The fair value is nothing but 95,000. Yes. So this fair value of 95,000. Tell me one thing. Do you think that counterparty 2 will pay counterparty 1, when they are transferring the liability, will they pay entire 1 lakh rupees? Will they pay entirely 1 lakh rupees? That is the value. Answer is no. आपके पास जो कर्जा है उसका market value is only 95,000. So why are you going to go and pay 1 lakh? The fair value is only 95,000. Are you able to understand? Yes.
Yes, sir.
And therefore, this ends up becoming your fair value. Any doubts?
No doubt, sir.
No doubts? Okay. Hemant, did you follow? Nisha, did you follow? Yes. All right. So this is an example. Okay. So therefore, transfer value would be 95,000 and thus its fair value. Okay. Now, question is, how do I do the valuation? So there are two instances, and the dhyan se suno, it's not difficult. Okay. A liability in my books can be an asset in the counterparty's books. Bolo yaar. Yes. A liability in my books can be an asset for somebody else. Yes or no?
Yes, sir.
Acha. A liability for me may not always be an asset in somebody else's books. Do you agree to that? Don't read the slide. Just to try to understand what I'm trying to tell you. मेरे books में एक liability है. Is it always going to be an asset in somebody's books or can it be isolatory? मतलब सिर्फ मेरे बुक में liability है, कहीं पर भी asset नहीं है. Can I have such kind of a situation? Nisha,
Yes.
is it possible?
Any example is not able to understand how it works now.
Yes. Okay. Pooja, you were saying something? Pooja? Okay. Definitely होगा. Definitely होगा. Because any provision that I make today need not necessarily be recognized as an asset in the counterparty books. Very simple. Today in my financial statements, when I prepare my balance sheet P&L, audited numbers are all ready, and I take the entry for provision for tax. Do you think my provision for tax, which I account here as a liability, do you think income tax department will recognize IT receivable as an asset from you?
No, sir.
नहीं होगा. नहीं होगा. Similarly, suppose I am entering into a sale value जिसका warranty obligation है, where there is a warranty obligation. Although now warranties are all covered under Ind AS 115 primarily, because Ind AS 115 we take it as a bundled supply, allocate my revenue between the product and the warranty, and warranty gets amortized over the time period. So typically that is how 115 is drafted. But for the time being, suppose it's not a material amount and warranty I choose to recognize as a separate obligation. My question to you is, a warranty obligation in my books, will it be an asset for the counterparty always? No. What about the others?
No, sir.
नहीं होगा. Okay. Last case. Provision for decommissioning and restoration. Okay, decommissioning and restoration of site. These are expenses to be incurred after say 15 or 20 years. So today I am creating a provision. My question to you is, if you make a provision today for something to happen after 20 years, do you know whom you are going to appoint for decommissioning and restoration?
No, sir.
Yes, you don't know. So if you only don't know whom are you giving the contract for decommissioning and restoration, how can the opposite party recognize it as an asset? नहीं हो सकता. So when I talk about my liabilities and or equity instruments, it could be either held by other parties as assets, or it could be not held by other parties as assets. Any doubts so far? No doubts. So now when it is treated as an asset by the counterparty, when it is treated as an asset from the counterparty, then you will first use the quoted price in an active market for identical team and by another party is, as an asset if available. So if your liability is quoted, जैसे debentures, I have issued debentures, these debentures are listed on the stock exchange, these debentures are an asset for somebody, that somebody will look and determine the value. Are you able to understand? Yes. So my debenture, a liability in my books, is somebody else's asset, and that somebody else's asset is having a market value, which I will assign straight away to my debentures because that is the value of my debentures. Are you able to understand? Yes.
Yes, sir.
Sure. So first preference, use the quoted price. If quoted price is not available, use other observable inputs such as quoted price in a market that is not active, for the identical items. And third preference, use a valuation technique such as income or market approach if observable prices in 1 and 2 are not available. Is it okay?
Sir, in this
Haan.
preference to the not active, what is the meaning of not active?
Not active, not active. Okay. So quoted price is not available. Use other observable inputs such as quoted price in a market that is not active. So typically when we talk about a market that is not active, this could be within a restricted market. Okay. Like for example, you have this private equities, okay, or venture capitals. So probably these would end up becoming markets which have a very limited days, which have a very limited days. It's not open to the public. But these entities are trading in unlisted entity shares. So therefore, that could end up becoming a market which is not open to everybody. It
Okay,
is an unlisted market. Okay.
okay,
For
sir.
the identical items held by another party as an asset. So did you understand?
Yes, sir.
Yes.
Yes,
So
sir.
basically, my liabilities valuation or my equity valuation depends on two things. One is if it is an asset for the counterparty. If it is an asset for counterparty, is there any change in the valuation approach? Answer is no. It is basically following the core principle of maximize the use of observable inputs, minimize the use of unobservable inputs. So first one, quoted price. Second one, price in a non-active market. And third one is you follow either a valuation technique or an income or market approach. Did you understand? Yes. Yes. So now held by other parties as assets is also done. This is also done. Okay. Okay. Shall we proceed further?
Yes, sir.
Yes. Now, the
Sir,
question is,
sir, there is a doubt here.
please ask.
Sir, for the liability, what should be the income approach? Like, how should we proceed? If it is a liability, right?
You are talking about,
The held by other parties as assets, preference 3.
yes, this one, what I marked just now, correct?
Yes.
So, suppose I have a debenture. Yes, this debenture is my liability. Can I say it is counterparty's asset? Yes.
Yes.
Now, if it is counterparty's asset, can I say that it will yield income to the counterparty?
Now understood, sir. Now I understood.
Okay. All right. So that is how it is. Okay. All right. Liability will not have its own income, but the liability, which is somebody else's asset, will have an income. So this part is basically if my liability is somebody else's asset, only then you can apply these three approaches. If it is not held by other party as assets, then you will measure the fair value using a valuation technique from the perspective of a market participant that owes the liability or has issued a claim on equity. Okay. Counterparty to hoga nahi. So I will do the valuation from my own perspective. Is it okay? Yes. So now coming to the next one. General principles. Assume that what is happening is a transfer and not a settlement. Not a settlement. Okay. Second, इसको ऐसे मत करो. Not a settlement. Okay. Of a liability. So is there a quoted price? If the answer to that is yes, please use the quoted price. Don't go anywhere else. Quoted price hai, take the quoted price, that will be the value. If there is no quoted price, then are there any identical items held as assets by another party? Okay, so now identical item held as an asset. Okay, now is there an identical item held as an asset? Answer is yes. Then use the fair value of identical asset. Of course, adjust the quoted price only if factors specific to the asset but not to the liability or own equity are present. If it is not held by another party as a liability, as an asset, Then apply present value technique, including expectation of cost and compensation. Are we okay with this? Yes. Basically, whatever we discussed in the last slide is summarized here. Any doubts here?
Clear, sir.
Clear? Okay, fine. Now we move on to the next one, applying fair value rules to liabilities and own equity. Okay. When I determine the fair value of liability, my liability in my books, then my own credit risk should be reflected in the value, should be reflected in the value. Did you understand what it means? Today, suppose I am having a debentures that I have issued and I need to do the fair valuation of that. So when I do the fair valuation, what I will get is your when I do the fair valuation, I will arrive at some value, but that value should reflect my credit rating. It should reflect my credit rating. I cannot take, say, for example, if I am an unlisted small entity, I cannot take the same assumptions that Tata Capital has done for its debentures issue. So therefore, I will start off with my own credit risk to be factored in the fair valuation. And what would be that credit risk? It could be a non-performance risk. It could be a non-performance risk. Are we able to understand? Yes.
Yes, sir.
Now, you will also have certain transfer restrictions that you will consider. Okay, that you will consider without any separate input or adjustment. And you will have a financial liability with a demand feature. Fair value is not less than the amount payable on demand, discounted from the first date that the amount could be required to be paid. So that is your financial liability with the demand feature. Okay, you just try to understand the terms which are there here. Okay, that's it. Nothing major is there in this particular concept. Whatever conceptual clarity we had to get, we got it right from the asset perspective. Okay, Hemant, please
Yeah.
ask what.
So for small companies, how will we get the credit rating?
Well, you have these entities, right? Like Sibyl is there, Crisil is there. You can definitely make an application to them, and you will have to submit your financials. They will then give you something known as the credit report.
Sir, if it is 800, they give the number 800. Normally, what you do is 800 by 1000. So we should take that 0.8 as the
I
the
think
factor.
nowadays the Sibyl rating is, yeah, it is reaching 1000, right?
Yeah, maximum is 1000.
The best
Maximum is,
score is 1000. So
yeah.
they give you something like 800, 790 to 800 range is what they normally give you.
Yes, sir.
Yes. So that you will have to factor it in your fair valuation when you are fair valuing your liability.
Okay,
Okay.
sir.
Because what can happen is, see, let me tell you, you have issued a debenture with a particular rate of interest. But by virtue of your credit rating, what should have been your interest becomes the fair value. Yes. In today's terms. So suppose I have issued 11% debentures, but actually for a company of my rating, the interest should have been 9% because of a very favorable CIBIL score. And therefore 9% becomes my fair value rate, which becomes the basis for valuing financial liabilities. Did you understand?
Yes, sir. Yes.
Yes, it will be different from the face value, no doubt about it. Okay, but this is how you are going to ascertain the fair value. Okay, now the next one is okay. Let us look into some illustrations. Okay, almost we are at the end of the chapter. Okay. X and Y each enter into a contractual obligation to pay 500 in cash to D in 5 years. X has a AA credit rating and can borrow at 6%. Y has a BBB credit rating and can borrow at 12%. Okay. X will receive about 374. So X is having an obligation to pay 500 rupees cash after a tenure of 5 years. So what I need to understand is what is the present value of this? What is the present value? And what is the rate of interest? 6% rate of interest. Is it okay? Is it okay? 6% rate of interest. Now, can somebody discount this to the present value and tell me? Bolo yaar.
Sir, 373.63.
So 374.
Yes.
Correct?
Yes, sir.
So this is basically 500 into 1 divided by 1.05 raised to 5.
Right.
Yes or no?
Yes, sir.
Correct. So present value of this instrument is 374. Can I call this present value as my fair value?
506.
Nisha?
6%, right? So it's 1.06.
Your voice is
Actually,
appearing.
sir, you have written 0.5. She is telling it should be 0.6.
Oh, 0.6. I'm sorry. Okay. Calculation ठीक था नंबर गलत है ठीक है so 1.06 raised to 5 374 so can I say that in today's terms the fair value of my liability is 374 yes and then at 6% it will accrue to 500 now the same thing let us look from the perspective of who is that other entity Y okay now Y के केस में there is an obligation to pay 500 after 5 years with a rate of interest of 12%. Yes. So 500 into 1.12 raised to 5.
284, sir. Approximate.
284. Present value equals 284. Anybody has any doubt here? So today if X were to go to the bank with its credit rating and he wants an instrument that he can pay 500 later. In today's terms, how much he will get? X is going to get 374, whereas Y is going to get only 284. So can I say that the fair valuation is incorporating the credit rating of each of these entities? Yes. Can I say that this is what is met in that particular value of 374 and 284? Yes or no? It is incorporated, right? It is incorporated. And therefore, you have to consider that. You will have to consider that. Okay, all right. So that takes care of this example. Okay. Now, this is a very interesting question. Okay. Let us start to look at this question because this is basically doing a fair valuation of your decommissioning liability. The fair valuation of your decommissioning liability. So let us see how to do this. On 1st January, A Limited assumes a decommissioning liability in a business combination. See, what happens is in a business combination, we take over all the assets and liabilities. Okay. So and all of that takeover should happen at fair value. When you study Ind AS 103, you will understand. So all my assets, liabilities should be taken over at fair value. The reporting entity is legally required to dismantle and remove an offshore oil platform at the end of its useful life, estimated to be 10 years. The following information is relevant. If A was contractually allowed to transfer its decommissioning liability to a market participant, it concludes that a market participant would use all of the following inputs, probability weighted as appropriate, when estimating the price it would expect to receive. So labor cost. Labor costs, obviously you need to have labor to dismantle it, right? So labor cost. These are developed based on current marketplace wages, adjusted for expectation of future wage increases, required to hire contractors to dismantle and remove offshore oil platforms. A Limited assigns probability to a range of cash flow estimates as follows. So there is an estimate of 100 crores and the probability of that is 25%. There is an estimate of 125 crore with a probability of 50%. There is a 175 crore estimate with a probability of 25%. So if I were to do a weighted average calculation, it would be 100 into 25% plus 125 into 50% and 175 into 25%. So now let us come to solve this question. This is question 7. Test your knowledge. So expected labor cost. How am I going to determine this? Year 1, 2, 3. Then cash flow 100, 125, 175. Probability 25, 50, 25. So therefore, expected cash flow 25, 62.5 and 175 into 0.25, 43.75, 131.25. Is it okay? Yes? Oh, this is not year-wise, sorry. This is case 1, 2, 3. Okay? Cases 1, 2, and 3. This comes to 100%. Is it okay? So my labor at the end of the tenure when I have to dismantle, my labor comes to 131.25. Any doubts here? Anyone? यहाँ तक सब ठीक है?
Yes, sir.
All right. Now, allocation of overheads. Allocation of overheads 80% of labor cost. At that time, labor के साथ overheads भी होगा. So this will be 131.25 into 80%. So that comes to how much?
105.
105. So 10 साल के कितने साल के बाद है ये? 10 years. Okay, 10 years. After 10 years, it is expected to be 105. Now, the compensation that a market participant would require for undertaking the activity and for assuming the risk associated with the obligation to dismantle and remove the asset. Such compensation includes both of the following. See, if I am transferring this obligation to somebody, that somebody is a market participant who is assuming the risk. So I will have to compensate him. So first one is your profit on labor and overhead costs. A markup of 20% is consistent with the rate that a market participant would require as a compensation for undertaking the activity. So labor is 131.25, overheads is 105 into 20%. So that comes to how much? 47.25. Are we okay with this?
Yes, sir.
47.25. The risk that the actual cash flows might differ from those expected, excluding inflation. A Limited estimates that the amount of that premium should be 5% of the expected cash flows. The expected cash flows are real cash flows, that is cash flows in money terms, in terms of monetary value today. Okay. Effect of inflation on estimated cost and profits. A Limited estimates that there is a rate of inflation of 4% over a 10-year period based on available market data. अच्छा, ये जो costs दिया 131, 105, 47, these are all in today's price terms. But when are you actually going to do the activity? You are going to do the activity after 10 years. So they are assuming an inflation rate of 4%. So for 10 years करना पड़ेगा. Are you able to understand?
Yes, sir.
So that comes to 1.04 raised to 10. 1.04 raised to 10. 2, 3, 4, 6, 8, 9, 10. 1.480.
0.
Yes. So a 1 rupee outflow today will be 48 paisa higher after 10 years. Okay, will be 48 paise higher after 10 years. Now, time value of money represented by risk-free rate of 5%. Non-performance risk relating to the risk that entity A will not fulfill the obligation, including A Limited's own credit risk, is 3.5%. A Limited concludes that its assumptions would be used by the market participants. In addition, A Limited does not adjust its fair value measurement for the existence of a restriction preventing it from transferring the liability. So this is correct. You don't have to do anything. Okay. No adjustment required because they have said that restriction on transfer should not be considered separately. You are required to calculate the fair value of the asset retirement obligation. So now let us start. Almost all the values we have calculated. So calculation of asset retirement obligation. So expected labor cost 131.25 already calculated. Allocated overheads 105. Profit markup, that also we have calculated on above. So that comes to 47.25. So this total comes to 283.5. What is this? Expected cash flows before or after inflation? Bolo?
For inflation.
Before inflation. Now, expected cash flows adjusted for inflation. What will it be? 283.5 into 1.4802. Yes or no? Yes.
Yes, sir.
So 283.5 into 1.02.
4802.
So 419.64.
64.
So this is what you expect the cash outflow to happen in the 10th year. Now, is there any risk adjustment? Yes. The risk that the actual cash outflows might differ estimates the amount of that premium to be 5%. Did you understand? Steve, what is he saying? These are my estimated cash flows. तो आज के तारीख में कितना आया है 419.64. But tell me one thing. Am I an astrologer with 100% accuracy of how much I will incur in the future? नहीं हूं मैं, हमें नहीं पता. तो is there a chance that the amount to be paid after 10 years, can it differ? Yes.
Yes, sir.
So that uncertainty in cash flow has a premium of 5%. Has a premium of 5%. Did you understand? Yes. So risk adjustment is equal to 419.64 into 5%. So that comes to how much? 20.98. So 419.64, 20.98, 440.62. Did you understand? Yes.
Yes, sir.
So this is the expected cash that will be the outflow after 10 years at fair value. And finally, we have to discount it to the present value. You will take risk-free rate of 5% plus credit rating related risk of 3.5%. Discount rate is equal to 5% plus 3.5%. Risk-free plus risk rating, etc. So that comes to 8.5%. 8.5%. Okay. All right. Now, let us move to the next one. So now I need to bring it to the present value. Expected present value is equal to 440.62 into 1 divided by 1.085 raised to 10. Yes or no?
Yes, sir.
बस तो calculate करो.
194.88.
Yes. Four 440.62 into 0.4423. 194.88. क्या है ये? This is crores. Okay, so 194.88 crores is expected to be your asset retirement obligation fair value today. Any doubts?
Clear, sir.
Clear? Okay, fine. So that takes care of question 7. Okay, all right. Now, okay, how fresh are we? See, hardly anything is left. I can complete the chapter in the next 25 minutes to half an hour max. Okay. So say by 9:20 to 9:30 के बीच में chapter gets over and then we can wind up. If you want a break, let me know. I don't need a break myself. खत्म कर दे chapter?
If everybody says so.
You are still fresh because today all that we have done is just done some mathematical calculations. That's it. Okay. So what we will do is we will complete the chapter discussion in totality. Okay. I'll not give a break. Break will be done along with closure of the chapter. Okay. I will be winding up a little earlier then. Okay. All right. Fine. Now, there are certain financial assets and liabilities with offsetting positions. Offsetting means what? A liability and an asset I can net set. I can net set. So my question is, when I talk about market risk, I could be having trade receivables in US dollars. I could be having liabilities to be paid also in US dollars. So can I say that my trade receivables and liabilities, can they offset each other to give me a benefit of the exchange rate fluctuations, to eliminate the uncertainties of exchange rate fluctuations? बोल सकते हैं हम? Yes? बोलो यार.
Yes, sir.
See, you people have studied hedging.
Yes, sir.
Yes? Hedging में सबसे पहले आपने पढ़ा होगा natural hedge. Name may be different, but when I say natural hedge, what does it mean? I have receivables after 60 days in US dollars. I have payables after 60 days in US dollars. तो मेरे को डॉलर वहां से आएंगे and I will pay off the dollars. So is it impacting my exchange flux? Is the exchange fluctuation going to impact me? Answer is no. You are automatically hedged by virtue of your transactions. Did you understand this?
Yes, sir.
Yes. So now the question that arises is, there are certain financial assets and financial liabilities where offsetting exists. So when I talk about fair value, should I fair value the financial assets separately, the financial liabilities separately, or can I do an offsetting and determine the fair value on a net basis? Did you understand the question? Yes?
Yes, sir.
Should I value my receivables and payables separately, or should I offset? Should I offset? Okay. Now see, there is a choice that is available. It is a choice. If there is a price receivable to sell a net long position, sell means I will be price receivable to sell a long position. That means I will get dollars when I sell. Correct? When I क्या बोलते हैं उसको? When I sell the goods to a customer, I will get dollars in the future. Yes or no? So these dollars have to be sold in the future by me. So it will be a price receivable to sell my long position. Did you understand? Yes. Against that, I have a vendor whom I have to pay in dollars. So at the due date, I will have a price payable to transfer a net short position. So now the question that arises is, how do I do my valuation? Both of these are on net basis. Okay. So now the question is, should I do a fair valuation of receivable separately or payable separately, or can I net it off? So the option that is available, the standard says it is your choice. Whatever you do, you need to have a documented risk management or investment strategy. You need to have given this information to the key managerial personnel that you intend to do a separate settlement or a net settlement. And you need to find out the fair value at the end of each reporting period and keep that as documented. Did you understand? ये तीन चीजें आपको करने ही करने हैं, whether you are going for separate settlement or net settlement. And based on these, you will end up deciding whether I will fair value on a net basis or on a gross basis. When you are applying an offsetting position, suppose you elect the choice कि चलो हम net settlement valuation करेंगे, you are allowed this as an exception. मतलब ideally you should be measuring the receivables and payables separately, but here you have this exception only if other market participants also manage the similar risk on net basis. Did you understand? Yes. So suppose your same party is your vendor, same party is your customer, and you are allowed to do a net settlement and others in similar situations also do a net settlement, then and then only you are allowed to pursue the net settlement. Did you understand this? Yes?
Yes, sir.
There should ideally be same information and market practice available for making these assets or liabilities on a net basis. Same information and market practice should be available. Once the exception to fair value certain assets or liability on a net basis is being used, once I come to a net basis valuation, unit of account we studied in the last class, you remember? Unit of account kya tha? It is either a standalone asset or a standalone liability or a group of assets and liabilities. Yes or no?
Yes, sir.
So in this case, if I go for a net setting, the unit of account would be considered as net. The unit of account would be considered as net. The market risk should be the same while combining any asset or liability. Market risk should be the same. For instance, interest rate risk cannot be netted off with commodity price risk. So you will have to check up net setting kiska karo. Receivables and payables is automatically a similar settlement because this is related to exchange rate fluctuations. Okay, that is exchange rate risks. But there could be certain cases where you will be tempted to do an interest swap risk. You will want to do an interest rate risk settlement with a currency settlement. That is not possible. The nature of risks that you want to knock off should be the same. The nature of risks should be the same. Duration of a market risk should be identical to use the exception for valuing assets or liabilities on net basis. For example, interest rate swap of longer period will only be allowed to value at net basis up to the duration of the financial instrument of the same duration. So again, duration also should be the same. You cannot do a net settlement of a receivable expected to come in 2 months against a payable expected to be paid after 3 months. Uska आप net settlement नहीं कर सकते. It has to be related to the same duration. So coming back to offsetting, first of all, is it mandatory to do an offsetting or is it optional? Bolo. It is optional. Okay. It is optional. Acha. So when we talk about offsetting, is it a regular practice or is it an exceptional practice? Offsetting, is it regular or exceptional? It is exceptional. Acha. That means preferred is what? I measure my assets fair value and liabilities fair value separately. But as an exception, you are allowed to go for measuring the fair value on a net basis. For doing this on a net basis, there are 3 conditions that you need to fulfill. First one, a documented risk management or investment strategy. Second, information should be available to the key managerial personnel about this, and you need to determine the fair value at the end of each reporting period. Okay? Did you follow? Yes?
Yes, sir.
All right. Now, let us move on to the next. If I have to do net setting or offsetting, then first one, it's allowed only if market participants handle it in the same way. Same information should be available and same market practice should be available. Unit of account will move from individual to a net basis. Market risk should be the same while combining any asset or liability, and duration of market risk should be identical. Is there anything which is illogical, or all these requirements are perfectly logical? Perfectly logical. आप अलग मार्केट रिस्क का ऑफसेटिंग नहीं कर सकते, अलग ड्यूरेशन का ऑफसेटिंग आप नहीं कर सकते, right? So that is but obvious. Okay, so therefore these are the requirements, and for the requirements, what are your precursors? Okay, so that is something that we are having as part of our offsetting discussions. All clear? Yes.
Yes, sir.
All right. So now we move on to the next one. Acha. Yaad karo, try to remember when the first day we saw the discussion of fair value, the definition of fair value. What did I say? Fair value is your, one second. Huh? Okay, now fair value, we always saw that it is an exit price, correct? Yes or no?
Yes,
It is
sir.
a price that would be received to transfer an asset or paid to transfer a liability. यही पढ़ा था हमने.
Yes, sir.
Now, somebody's exit price will be the counterparty's entry price.
Yes, sir.
बोलो यार, अगर मैं किसी को बेच रहा हूं तो कोई खरीद भी रहा है ना सामने से.
Yes, sir.
So my exit will be that person's entry price.
Yes, sir.
So ideally, entry price, exit price should be the same. है कि नहीं? If I sell this cell phone to you for 10,000 rupees, your purchase price will be 10,000.
Yes, sir.
हो गया ना? फिर exit price and entry price became the same. Yes or no?
Yes, sir.
For all cases, this will be the same. For all cases, this will be the same. So we started with a discussion saying that fair value is the exit price. But we are now coming to the discussion that entry price ho chahe exit price ho, it will be equal, except in 4 cases. Except in 4 cases. That is why when we discussed, we sought the discussion from an exit price basis, because exit price discussions on fair valuation is always going to work. There won't be any ambiguity about it. When I talk about entry price, exit price won't be equal in 4 cases. What are those 4 cases? First one, a transaction between related parties. A transaction between related parties. I am going to sell my asset to a related party. Do you think it will be fair value? Answer is no. There will be some kind of favor that you are expected to give. There will be some kind of favor that you are expected to give. Either a reduced price or a reduced interest rate or generous payment terms. Okay. So there will be some kind of adjustment that will happen. Thereby, what will happen is, so for instance, I have taken a debenture liability on my head, and I want to transfer that debenture liability to my subsidiary. Subsidiary is in need of funds. So when I transfer that debenture liability to the subsidiary, I know my fair value because I am the one transferring the liability. But सामने वाला तो मेरा अपना है ना, वो बेचारा अपना ही तो बंदा है, उसको पैसा चाहिए. So there is a chance that I will pay him more than the fair value. Yes or no? बोलो यार. There is a chance I will pay more than the fair value, and therefore, my whole point of saying is that the entry price will not be the same as exit price in the case of related parties. Exceptions, it is at perfect arm's length. It is at perfect arm's length. So this is first. Exception. Second exception, sale under duress or a forced seller. Okay, suppose I am in distress and I want to sell an asset. Can you sell at fair value? आपको कैश की अर्जेंट रिक्वायरमेंट है एंड द मार्केट नोज इसको कुछ भी दे दो ये ले लेगा बिकॉज ही नीड्स द कैश, राइट? सो व्हेन दैट इज द काइंड ऑफ situation you are in, can I expect the transaction to be at fair value? Answer is no. And therefore, your fair value, your transaction price will not be equated to the fair value. Entry price and exit price won't be the same. Third case, a different unit of account. Suppose I sell my division as a slump sale. I sell my division as a slump sale. Now, when I sell it on a slump sale basis, am I assigning individual values to each asset and liabilities? Jeannie? Nisha? No. You are not assigning individual values to assets and liabilities. You are assigning a lump sum consolidated value. Did you follow? Yes. But the other party is getting different assets and liabilities. Yes or no? He is getting an undertaking, but if he has to account it in his books of accounts, he has to assign value to each asset and liability. भाई वो अपने बुक्स में थोड़ा ना दिखाएगा डिविजन 100 crores. He has to write all inventory values, all receivable accounts, all payable accounts, any other liabilities taken over. He has to assign values to each of them. Yes or no?
Yes, sir.
So a slump sale invoice will be just sale of division 100 crores. GST also is not applicable on that. But the other party has to account for it asset-wise, liability-wise. So can I say that unit of account is different?
Yes, sir.
Now, when the sale value is 100 crores on a lump sum basis, the opposite side, I will record asset 1, 2, 3, liability 1, liability 2, and this accounting will be at fair value. Do you think this and this will ever match? Do you think my fair value here and this 100, will it match?
No, sir.
नहीं होगा. If it matches, it is a coincidence. But it doesn't match. Either there will be a surplus that you have paid, or there will be you paid less and you got more. Okay, इन दोनों में से एक ही चीज तो हो ही सकता है. Okay, so now this fact that they are different units of account has given rise to a difference between entry price and exit price. And that is why this ends up becoming your different unit of account, giving rise to a different entry price and different exit price. Is it okay? Yes.
Yes, sir.
And finally, if the sale has not happened on the principal or most advantageous market, but in some other market, then the entry price and exit price will not be equal. Apart from these four cases, your entry price will always be equal to exit price, and therefore your transactions will always end up becoming equal. So fair value as an exit price definition always stands good, but to make it equal to entry price, these 4 exceptions have to be eliminated. Is it okay?
Yes, sir.
Pooja, did you follow? Nisha, Niranjan, Usha?
Yes, sir.
All right. So fair value at initial recognition. All right. Now, you have studied Ind AS 41?
Yes, sir.
Acha, so you have studied. Okay, fine. Great. So now, just a second. Okay. Entity A purchased a cattle at an auction on 30th June 2019. The purchase price is 1 lakh. The cost of transporting the cattle back to the entity's farm is 1,000. Sales price of the cattle at 31st March 2020 is 1,10,000. The company would have to incur similar transportation cost if it were to sell the cattle at an auction, in addition to an auctioneer's fee of 2% of sale price. The auctioneer charges 2% of the selling price from both the buyer and the seller. Calculate the amount at which the cattle is to be recognized in the books on initial recognition and at the year end of 31st March 2020. Tell me. Biological assets, they should be accounted at which cost? Cost, fair value less cost to sell. किस रेट पे आप account करोगे?
Fair value less cost to sell.
Fair value less cost to sell. Okay. So now, purchase price is 1 lakh initially. Yes.
Sir.
From here, I will deduct the transportation cost.
1,000.
And from here, I will also deduct auctioneer's costs.
Yes, sir.
2,000. So that comes to how much? 97,000.
97,000.
So you will be measuring the cattle at 97,000. But what is the cash outflow that is happening? 1 lakh you will pay for the cattle, 1,000 for transportation, 2,000 for your auctioneer fees. Yes or no? So
Yes.
1 lakh 3,000.
3,000.
So to buy an asset at fair value less cost to sell of 97,000, you have paid 1 lakh 3. Therefore, loss on initial recognition. Loss on initial recognition is how much?
6,000.
Okay. So 97, 1 lakh 3, resulting in 6,000. Now, 31st March 2020, fair value less cost to sell. 31st March 2020 is equal to 1,10,000 minus 1,000 minus 2% of selling price. So 1,10,000 into 2%. So that gives you how much?
2,200.
2,200. So 1,10,000 minus 1,000 minus 2,200. So that comes to 1,06,800. Initial recognition, we record at 97,000. And on 31st March 2020, 1,06,800. Is it okay? Yes? All
Yes.
clear?
Yes, sir.
Fair value less cost to sell. All right, perfect. Now, let us move on to the last question. Okay. Rohini Limited, a listed company, owns an asset that is traded in different markets, which has to be fair valued at fair value under Ind AS. Rohini currently only buys and sells the asset in the Maharashtra market. So Rohini is operating here. Okay. Now, the information relating to the asset is as under. Volume of the market 40 lakhs in Kerala, 20 lakh and 10 lakhs. Price is given. Cost of entering the market is given and transaction cost is given. Okay. Now, let us first answer this question. Then we shall move on to the next one. Okay. Now, if I look at the markets, I have Kerala, Rajasthan, Maharashtra. Price 1,330, 1,120, 1,540. So 1,330, 120, 540. Cost of entering the market, that means the transportation cost, is 140, 140. Maharashtra mein I will not subtract it because I'm already in the Maharashtra market. Did you understand? So therefore, cost of entering the market is 0 for Maharashtra. For the other two, it is going to come. Now, potential fair value 1190, 980 and 1,540. Did you understand? Yes. And if I deduct the transaction cost 70, 140, 140, that leaves you with net proceeds. Any doubts till here?
No, sir.
All right. Now, Rohini is already operating in the Maharashtra market. So therefore, cost of entering Maharashtra market is not incurred and therefore it is irrelevant. हम फिर से उसी मार्केट में जाएंगे नहीं, हम उसमें बसे हुए हैं. We are already settled in the Maharashtra market. Fair value is not adjusted for transaction cost. We have seen that. So therefore, why? Because they are not a feature of asset or liability, but they would be considered while determining the most advantageous market. Is it okay? Yes. ये तो पढ़े हैं हम लोग. Yes. Yesterday. Yes or no?
Yes, sir.
थक गए हो? Okay. The Kerala market ends up becoming your principal market because of the sheer volume. It is double of Rajasthan and it is quadrupled of Maharashtra market. So therefore, the Kerala market is the principal market. And if this were to be the principal market, what would be my fair value? 1,190. Based on Kerala market, the fair value would be 1190. Is it okay?
Yes, sir.
Obvious. If information about Kerala market is not available, or if Rohini cannot access that, then we move on to the next one, that is the most advantageous market. Most advantageous market कौन सा रहेगा इसमें? Obviously, it will be Maharashtra market because it is maximizing the net proceeds, right? The
Yes,
most advantageous market is the Maharashtra market. Cost of entry are not relevant, and based on this, the fair value would be 1,540. It is assumed that market participants are independent of each other and knowledgeable, able and willing to enter into transactions. So that takes care of this part. So the question was how the fair value should be measured. So we have done the first part, fair value measurement. Now we come to the next part. Additionally, same question what we just now did. Acquired an entity required to fair value a decommissioning liability. The entity has to decommission a mine at the end of its useful life, which is in 3 years' time. Rohini has determined that it will use a valuation technique to measure the fair value of the liability. If Rohini is allowed to transfer the liability to another market participant, following data would be used. Labor and material cost, overheads, third party markup, this is your profit margin, what we saw, non-performance risk 2%, annual inflation rate 5%, risk adjustment cash flow uncertainty 6%, and government bonds risk-free rate is 4%. Can you try this for homework? Is there any difference compared to the question that we just now did in detail? मैंने ये question पूरा solve किया था ना?
Yes, sir.
It is exactly the same.
Yes.
Nothing else is there in this. Okay,
Yes,
वो
sir.
same to same. And this solution also is already there on your portal. Okay, so you can refer and solve it. My advice, try to do it yourself before referring the solution. Okay,
Yes, sir.
try to do it yourself before referring the solution. Okay, so now question 2 is done. Now, an entity shall disclose information. Okay, now disclosures, what all are you going to give? Okay, so disclose information that helps users assess both of the following. For assets and liabilities measured at fair value on a recurring or a non-recurring basis, the valuation techniques and inputs used to develop those measurements is what you will disclose. For recurring fair value measurements using unobservable inputs, the effect of these measurements on P&L or other comprehensive income. And what all are you going to disclose? We have जो भी whatever we have marked, that is what you will disclose. Okay, so you will be disclosing fair value at each reporting date, level 1, 2 or 3, whatever you have followed, reasons for measurement, non-recurring, level of hierarchy, fair value as well as the disclosure, transfers, valuation techniques have to be disclosed, changes in valuation, quantitative. So all these are the disclosures that you will be required to give. Okay, so that is something that we have discussed. So if I come back to our summary of what all we have covered so far, we have covered need for Ind AS 113. We have covered need for Ind AS 113 along with objective and scope. We have also covered the meaning of fair value. What are the aspects surrounding fair value, whether it is asset or liability specific, unit of account, market participants, appropriate market, and price. We have seen all these definitions. We have gone on to discuss valuation of non-financial assets, where we follow the highest and best use. If it is not clear the highest and best use, we assume that current use itself is the highest and best use. So when we talk about highest and best use, 3 points we have to see. Is it legally permissible, physically possible, and financially feasible? These are the 3 things that you will have to answer to determine highest and best possible use. Valuation techniques, we saw inputs to valuation techniques, adjustment to quoted price, and approaches to valuation. So valuation techniques, there is one sound rule, that is maximize the use of observable inputs, minimize the use of unobservable inputs. We categorize our inputs into level 1, 2, and 3. Level 1, quoted price without any adjustments. Like for example, shares, you can directly take the market price. If it is a 24 karat gold, you can directly take the value from the market and that becomes your quoted price. Level 2 inputs, quoted price with certain adjustments. Like for example, if I have 18 karat gold, okay, so then I will make an adjustment with the 24 karat gold to determine that value. Shares of an entity in a similar sector, I can pick up the entity value of the entity which is already on traded, and then I will make certain adjustments. Okay, and level 3 is unobservable inputs, where it depends on management estimates. Typically it goes along with your DCF and other similar valuations. So now when we talk about inputs to valuation techniques, these are our 3 inputs. Rule is maximize the use of observable inputs, minimize the use of unobservable inputs. Coming next to applying fair value rules to liabilities and equity, applying fair value rules to offsetting items. We have seen this particular categories, whatever is my fair valuations that I have to follow for liabilities and equity. It is essentially two categories. One is whether my liability is counterparty's asset or my equity is counterparty's equity. In any case, own equity, I do not revalue, but the liabilities, if it is counterparty's asset, then what I will do is I can follow level 1, 2, and 3 inputs of valuation there. I can either take the quoted price of my own debenture, for example, or similar entity, I will do some adjustment, level 2 valuation, or level 3 valuation, I will do a discounted cash flow approach and income approach to do the valuation. Then we move on to the next one, that is, if my liability is not an asset in somebody's books, then we will have to follow unobservable inputs most of the case. When we spoke of approaches to valuation, three approaches: market approach, income approach, cost approach. Market approach, take the market value. Typically, it is in sync with level 1, in some cases with level 2 inputs. Your income approach is purely level 3 inputs, unobservable, DCF based. And when we talk about the cost approach, it is a more of a balance sheet based approach, a net asset value based approach. When we talk about fair value at initial recognition, we saw that what is my exit price will become my entry price for the counterparty. There are only 4 cases where it will not be equal: transaction with related parties, transactions under stress or under duress, where the unit of account is different, or where the sale has not happened on the principal market and it has not happened on the most advantageous market also. In such situations, the entry price will not be equal to the exit price. In all other cases, they will be the same. Okay, because basically they would be at arm's length. Okay, and then we saw the certain questions that we discussed today. Okay, so with that, I think we have covered in detail your fair value measurement. Okay, so at this point, if you have any doubts, please feel free to ask. Okay. Told you, I took half an hour and after that 5 minutes to discuss the entire summary of whatever we have covered. So at this point, any doubts, any queries? Pooja, Nisha, Niranjan, Usha.
Sir,
Yes.
fair value determination as per level 1 और level 3 नहीं, level 2 and 3 में कभी कभी confusion होता है सर.
See, level 2 में क्या होगा ना, level 2 is basically, आप ऐसे समझ लो, level 1 observe, that is copy paste. ठीक है, you take a value, just paste it in your fair valuation, that becomes level 1 input. level 2 की अगर हम बात करें, level 2 की बात करें, observe plus adjust, मतलब it will be copy plus paste plus adjust. मतलब there is an observable input, but you need to make certain adjustments. आपको थोड़े adjustments करने पड़ेंगे, right? Either you are measuring a comparable entity's fair value, जिसके लिए आपको adjustment करना पड़ेगा, liquidity discount or stake adjustments, whatever it is, you will have to do the adjustments. But you do have, आपका fundamental base is what? You have an observable input. जैसे if I take 18 karat gold, 18 karat gold does not have a traded price, but I have a 24 karat gold price. So 24 karat gold plus an adjustment for the 18 karat, the 6 karat reduction. Proportionately हम कर सकते हैं. So that is what is level 2. Level 3 inputs calculate. आप ना ऑब्जर्व कर सकते हो, ना ऑब्जर्व करके एडजस्ट कर सकते हो. It has to be only calculated. It is calculate based on assumptions. Based on assumptions. Is it okay? Yes?
Yes.
तो इसकी वजह से ये ऐसे होगा. Now, 2-3 एक्सेप्शन है. फर्स्ट एक्सेप्शन क्या था, मैंने बताया था. लेवल 1 इनपुट है, बट देर इज अ प्राइस, देर इज अ सिग्निफिकेंट इवेंट दैट हैज हैपेंड, जिससे आपका प्राइस नेक्स्ट डे बदल गया है. सो व्हाट आर यू गोइंग टू डू? ऑब्जर्वेबल है, but you are taking the next day's price because that is a better representative of the fair value. So level 1 हो करके भी it is moving into level 2. Did you follow? जैसे हमने वो एग्जांपल देखा था, राइट?
Yes, sir.
फार्मा कंपनी का 36 रुपीज क्लोजिंग था, 1 अप्रैल को 22.5 हो गया. So in my financials I will go ahead with 22.5 because that is a better representative of the fair value. Second exception is level 2 input है. You have observable input plus adjustments. So ideally it should be level 2, but the adjustments are so significant in nature कि I cannot really put it as a level 2 adjustment. It has to go to level 3. So though I'm observing and adjusting, significant adjustments हो गए तो वो level 3 input हो गया despite the process being level 2. And level 3 तो है ही आपका DCF and all of that put together, right? So that is how it is.
Yes, sir. Clear.
Clear? और कुछ?
No, sir.
All right. Anything else? Anybody else?
Clear, sir.
All right. Perfect. Perfect. That's it. So that takes care of my discussions. Just a second. All right. Anything else?
No, sir.
No doubts. Okay. All right. Nisha, all clear, right?
Yes, sir.
Okay, perfect. So from my side, I think we are done with the session. Right? I didn't give a break, so we could complete it. Otherwise, it would have gone till around 9:40, 9:45. Okay.
So please upload this annotated file.
हाँ, ये डाल दूंगा मैं, आज डाल देंगे. ओके,
Okay.
बाकी के तो मिल चुके होंगे आपको.
Yes, sir. हाँ, कल ही मिल गया.
Okay, all right.
Thank you, sir.
Okay, yes. Nothing else for me to discuss. हो गया सब. Yes, all right. ठीक है. ठीक है सर, सेशन कंक्लूड. हाँ, ब्रेक भी नहीं दिया. ठीक है. थैंक यू. थैंक्स
Thank
एवरीवन.
you, sir.
Thank you. Have a nice day.